The market is currently closed, and the last reported price for BigBear.ai Holdings, Inc., trading under the ticker BBAI, was $6.82 at the close of the trading session on Thursday, December 5, 2025. This closing price represented an intraday movement that had the stock finishing near the middle of its recent range, a notably calmer end to a week that has seen considerable volatility surrounding a key corporate action. The immediate headline insight that cuts through the noise of the stock's recent movement is not just the recent earnings beat, which is old news now, but the dramatic internal struggle playing out on the corporate governance front, specifically the highly contentious yet ultimately unsuccessful shareholder vote to significantly increase the authorized share count. The market often discounts non-financial developments, but in a company like BigBear.ai, which has been extremely capital-intensive and dilution-prone, the market's initial complacency about the vote's potential impact was perhaps misplaced. The fact that the proposal to authorize a doubling of shares to 1 billion failed to pass by the initial deadline, with the vote now having to be extended, introduces a new, highly unpredictable variable for the stock. This failure signals deep internal resistance to what management viewed as a necessary tool for future acquisitions and raising capital, and it forces a fundamental re-evaluation of the company's growth strategy and its future access to funding. This is the unexpected complication that investors need to contend with, and it's a far more material issue than a single quarter's revenue beat. The common understanding of BigBear.ai stock, particularly among retail participants who track the broader AI and government technology sector, is that it is a high-growth, high-risk play positioned directly at the intersection of defense spending and cutting-edge artificial intelligence. The expectation, largely solidified by the Q3 earnings report, where the company reported a narrower-than-expected loss of 0.03 cents per share against an expected 0.07 loss, and the simultaneous announcement of the $250 million Ask Sage acquisition, was a continued, albeit volatile, move upward. Retail sentiment, especially in the context of the recent year-to-date gain of over 130%, has been focused on the narrative that BigBear.ai is transforming from a legacy government contractor into a sophisticated, modern data analytics firm with significant ties to national security, a powerful combination. They see the backlog of nearly $400 million, coupled with the strategic acquisition that adds generative AI capabilities and government client depth, as a clear path to eventual profitability. The market's initial reaction to the Q3 news was a significant spike, reinforcing this expectation. However, the deeper reality is that this stock's valuation is currently less about quarterly results and more about its ability to finance its ambitious growth agenda, which brings us back to the shareholder vote issue. The reality is that the stock is now grappling with a significant capital structure constraint that directly challenges the high-growth narrative the market has bought into. The massive institutional ownership activity over the last quarter underscores this tension. Firms like Vanguard and BlackRock have been increasing their positions, seemingly backing the growth strategy, while others like Renaissance Technologies have significantly reduced theirs, signaling skepticism about execution and perhaps the capital raise strategy. The stock's high volatility, as evidenced by a 52-week range spanning from $2.36 to $10.36, is the clearest indicator that the market is deeply divided on the BBA story. Analyzing the recent daily stock movement reveals a sharp multi-day consolidation phase that followed the initial volatility surrounding the vote and the news of the extension. Trading volume, which had surged to over 100 million shares daily during the peak of the news cycle, has settled back down, but it remains significantly elevated compared to the monthly average, indicating persistent institutional and retail interest. The price action on the day of the close was relatively tight, ranging from 654 to 704. But the key technical pressure point is that the stock is currently trading slightly below its 50-day moving average, a level that technical analysts view as a potential trigger for further selling pressure if broken convincingly. This short-term weakness, following a very strong multi-month run, suggests that the market is processing the dilution uncertainty. The revenue decline of 20% year-over-year in Q3, despite beating estimates, is another reality check that undercuts the growth story. While management attributed this to the completion of certain U.S. Army projects, the market needs to see clear, accelerating growth from new commercial and government contracts to justify the current market capitalization of nearly $3 billion. The acquisition of Ask Sage, which is expected to bolster future recurring revenue, is a positive catalyst, but the immediate pressure is on management to demonstrate an ability to execute on the integration and the new contract wins, rather than just announcing them. The stock has outperformed both the S&P 500 and its sector over the past year, which means the baseline expectation for its performance is extremely high, and any misstep in execution or financing will be magnified. This brings us to the critical and often overlooked aspect of BigBear.ai's current situation, the level of short seller attention. In the world of high-flying, high-multiple, yet unprofitable growth stocks, BigBear.ai is a significant short seller target. The company currently faces notable short interest, and while the most recent official data is generally delayed, the current level of short interest as a percentage of float is substantial, and the borrow rates have been seen to fluctuate dramatically, an indicator of rising demand to short the stock. Firms taking a short position are fundamentally betting against the management's ability to turn the corner from high losses to sustainable profitability, and are specifically pointing out the company's history of substantial shareholder dilution and persistent net losses, including a massive loss of nearly $300 million in the previous fiscal year. The core short thesis is simple. The stock's valuation, with a price-to-sales ratio above 16, is completely disconnected from its operational performance, which shows stagnant revenue and deepening losses, particularly when non-cash items are excluded. They view the stock as a prime example of an AI by association hype trade. Investors need to be aware of this counter-narrative and the actionable insights associated with it. You can track the current short interest data, which is typically released mid-month for the previous period, on financial data websites. A rising short interest, coupled with a rising cost to borrow, which you can often find on your broker's platform, signals increasing conviction among short sellers and a possible supply constraint of shares to borrow, a key ingredient for a potential short squeeze. However, retail investors should treat this not as a direct invitation to chase a squeeze, but as a necessary data point. Short interest in this stock is a significant headwind that will cap upward moves unless a major, truly fundamental catalyst emerges. The actual business of BigBear.ai is deeply rooted in providing decision intelligence solutions primarily for government and defense agencies by leveraging big data analytics and machine learning. Their platform takes massive, complex, and disparate data sets, everything from satellite imagery to logistics data, and uses AI to process and synthesize this information into predictive, actionable insights. In essence, they move beyond simple reporting to telling their clients what is likely to happen next and the optimal action to take. This is why the national security component is so important. The government is their anchor client, providing stable, long-term contracts, though often at lower margins and with revenue lumpy due to government funding cycles. The recent acquisition of Ask Sage, which focuses on generative AI for the defense sector, is a tactical move to modernize their offering and gain access to higher-margin software-as-a-service style recurring revenue, a model the market rewards with higher valuations. Historically, the company has grown via a series of acquisitions and has struggled with the messy process of integrating disparate business units and technologies, which is a common pitfall for companies grown this way. This is where the tension between expectation and reality is most pronounced. The expectation is